Ladies and gentlemen, good day and welcome to GMM Pfaudler Limited Q3 and 9 months FY23 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Priyanka Daga from GMM Pfaudler. Thank you, and over to you, Ms. Daga.
Thank you, Neera. Good afternoon, ladies and gentlemen. A very warm welcome to all of you into the Q3 FY23 earnings call of GMM Pfaudler Limited. The earnings presentation was uploaded on the stock exchanges last evening and is also available on our website. Hope all of you had a chance to go through it. From the management, we have with us our Managing Director, Mr. Tarak Patel, our CEO of International Business, Mr. Thomas Kehl, our CEO of India Business, Mr. Aseem Joshi, our CFO of International Business, Mr. Alexander Pompner, and our CFO of India Business, Mr. Manish Poddar. We will give you a brief overview of the performance of the company, after which we will get into the Q&A. Before we begin with the overview, a brief disclaimer. The presentation which we uploaded on the stock exchange and our website, including our call discussions that will happen now, contains or may have certain forward-looking statements regarding our business prospects and profitability, which are subject to several risks and uncertainties. The actual results could materially differ from those in such forward-looking statements. I will now hand over the call to Mr. Patel to provide an overview of the performance. Over to you, Tarak.
Thank you, Priyanka. Good afternoon, everyone. I am pleased to report another good quarter driven by strong execution across geographies. Our overall performance remains on track, and we are confident of meeting our FY25 guidance. In terms of financial performance this quarter, we reported a revenue of 792 crores, which is a growth of about 23%, and EBITDA of 118 crores, translating to a growth of 43% with an EBITDA margin of 14.9%. I would like to also highlight here that there are two one-time exceptional items. One is on the basis of an inventory provision where we were actually going to supply a large reactor from UK to China, and the application of this export license was rejected by the UK the government. Obviously, we have taken the most conservative approach and provided for the entire order. However, we will be reapplying for the export license, and there is a good chance that this export license will come through. And obviously, at that point of time, we would then provide for this in a positive manner. The other option for this equipment is obviously to sell it to somebody else. And if this export license is rejected again, we would then look at selling to somebody else, or then finding another way where we could probably remove the glass and then send it to China. So there are multiple options there. The other one is for the acquisition-related expenses, again one time, and that is to the tune of about 8 crores. The PAT was also impacted by a one-time mark-to-market forex loss. This is a non-cash item, and obviously in the first two quarters we had a forex gain, but in this quarter, because of intercompany loans, we had a forex net loss. In terms of our business performance, our shipment and order intake for the year is ahead of plan, and the outlook remains positive. Our technologies and services platforms are seeing good traction across geographies, and our systems business, the opportunity pipeline remains quite strong. The order backlog as it stands today is about 2,247 crores, which gives us about a 6 to 9 months of revenue visibility. We've also done a large stock and sale order has been fulfilled. 24 vessels have been shipped to Germany. Out of these, 7 have been sold, and the reordering of new equipment are in process. At the same time, I would still like to mention that commodity and energy costs do remain a concern. However, we are working on cost control measures across geographies, and hopefully that will help mitigate some of these costs. In terms of other updates, we recently, as of this morning, completed the acquisition of Mixel France SAS and its wholly owned subsidiary Mixel Agitator Company Limited in China, in France and in China. The total consideration for this was about 7 million euros. Mixel has a revenue of 13.2 million with an EBITDA margin of about 12%, and the backlog and the business visibility remains quite strong. This is a good acquisition for us as it helps us improve our mixing the portfolio, gives us access to new industries and to new technologies. Lastly, I would also like to make a statement regarding the recent liquidity event. DBAG is a responsible shareholder and has been a strong supporter of our business and management team since 2014. The lock-in agreement was between the Patel family and DBAG, so that DBAG would not exit until the successful integration of the Pfaudler International was completed. This was estimated to be around 3 years, but as many of you know, we actually outperformed and completed our 2020 guidance 1 year ahead of plan, and it was hence decided that this was the right time to start off DBAG's divestment. The recent liquidity event and sale of nearly 17.3% stake held by DBAG to high-quality investors shows that the strong demand and interest in our business. The Patel family is now the largest single shareholder and has continually increased our stake since 2020. Further, we have also agreed to purchase an additional 1% in the business from DBAG at a price of 1,700. Regarding the balance stake of DBAG, it will be sold to the right set of investors at the right time. At this point of time, I would like to now pass on this to Manish, our CFO of the India business, and he will take you through the numbers in more detail. Thank you.
Thank you, Tarak. Good afternoon, all. We start with the consolidated numbers. The revenue for Q3 of FY23 stood at 792 crores, a decent 23% growth YY. EBITDA margin stood at 15% at 118 crores. This is a 2% increase in the margins YY. PAT also is up YY. However, in the current quarter, we were hit by a couple of exceptional items worth 22 crores. First one was the inventory provision of 14 crores. As Tarak explained, this was a GLA equipment shipment planned from UK to China. Because of the rejection of the export license, we could not ship it out, and therefore we took a conservative view of providing 100% of the 14 crore rupees. The second exceptional item was on the legal cost on the recent acquisitions and the add-on sales ban proposed for 8 crore rupees. Apart from these two exceptional items, we also had a forex MTM loss of 18 crores, which is a non-cash item on the foreign currency borrowing. This is on the Indian loans in euro, and as you know, this quarter euro appreciated, so hence this liability and the resultant loss was incurred. Again, this is a non-cash item. And likewise, on the YTD performance, revenue stood at 2,300 crores, up 26%. EBITDA stands at 14.5% at 335 crores, up 3% margin YY. PAT also stands at 199 crores, up 2.5% last year. Therefore, you will observe that we are on track to achieve our guidance for FY25, which is 3,700 crores of top line and 630 crores of EBITDA. Over to you, Priyanka.
Thank you, Manish. Neeraj, we can now open the line for questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, you may press star and 1 to ask a question. The first question is from the line of Utsav Mehta from Edelweiss Asset Management. Please go ahead.
Hi team, good afternoon. Thank you for taking my questions. First one, what is the gross debt as it stands currently and how much of that is in foreign currency?
Utsav, hi. The gross debt stands at something like 800 crores and 400 crores is in international business, which is obviously all in foreign currency, local currency in those countries, and another $5 million of ECB, which is there in India. Apart from that, we of course have some $25 million of cash, so net debt will be less than that.
Okay, and this excludes the employee liabilities, right? Pension liabilities.
Yeah, this is the total debt. This is only the debt to the bank.
Okay. I just wanted to understand the 18 crore foreign currency translation loss on an international debt of 400 crores. That's almost 5% for a quarter.
Okay. So this is not on the bank debt. This is an intercompany loan, a legacy loan out of the previous, once we acquired the business from DBAG itself. This is a loan from a euro entity to a dollar entity. The loan is in euros. So while the debt gets knocked off as we consolidate between the loan received and the loan paid, the forex fluctuation gets impacted because the dollar entity has to pay in euros. Therefore, you would have seen Q1 and Q2, we had a positive impact of 22 crores each quarter because the euro depreciated. This quarter, euro appreciated, therefore there is a loss of 18 crore rupees. This is not on the 400 crores of PFI debt.
Okay. Sorry, how much was the gains that were booked in the earlier quarters?
22 plus 22, something like 44 crores in H1 of this year.
So maybe you want to just add about the 9 months, we are still positive, right? There is a gain on the 9 months.
There is still some 24-25 crores of gain, net gain is still there.
And that gain is in other income, is it?
This entire piece sits in the other income.
Perfect, great.
Just to conclude this point, so therefore you see the other income for 9 months is 37 crores versus 5 crores, so majority of that is, as Tarak mentioned, is the rest of the gain that we have.
Okay, great. Tarak, you guys have given a sort of a guidepost in terms of the EBITDA that you want to achieve, but I also wanted to understand this 800 crores of debt. Sort of, what is the target in terms of bringing this number down, and how will you go about achieving it over the next 3 years?
Yeah, hi, Utsav. So we have a plan in place. So the actual number is not 800 because we have cash on hand as well, so it's lower than that. However, we do have a plan to be debt-free by FY28. However, we believe that it will be sooner than that. We do have some small acquisitions lined up, but nothing significant. So most of the cash that we will generate now, and our cash generation is, we have a track record of generating good cash flow. So I think over time you will see that the debt numbers will reduce significantly. And we obviously have a plan to remain below the 1 time EBITDA to debt, and hopefully it was lower until we acquired obviously the 46% held by DBAG very recently, and then we made this new acquisition in Mixel. But I think over time you will see that the number will start to reduce and come significantly below the 1 time mark.
So from this 800 crore number, should I assume will be a peak number? From here on in, it should decline?
Yeah, so I think that is around where we will be. I don't think this number is going to increase significantly at all. If anything, you will see it going down over time.
Okay, wonderful. And one last question from my side.
Just to clarify, net debt today is how much?
Minus 300, so net debt could be something like 500.
Yeah, so 500 because we have cash on hand, so the net debt is about 500 odd crores.
Understood. One last question from my side. At the analyst meet, you had mentioned that high cost inventory, especially in India, will be sort of done by the second quarter, and in the third quarter itself, you'll start seeing some benefits of that. But the standalone business in India this quarter has still shown a sort of 50% gross margin and 15% EBITDA margin. So just wanted to understand, how this number will trend over the next few quarters.
So let me just start off by saying that you're absolutely right. We were hoping for some positive impact of metal pricing reducing and the old inventory actually moving out. But again, this quarter we had a very large shipment of one specific job for heavy engineering. So there is a significant change in product mix. The India team, Aseem and Manish, are both working on improving the margins here in India. Obviously material costs still remain a concern. They are still about twice the amount it was about 12 to 18 months ago. There has been significant increases. We try and pass on as much as we can to customers. The heavy engineering business, like you know, is definitely not as lucrative as the glass lining part of the business, and the product mix itself is having an impact on margins. But we do believe that we have taken some actions over the last few months where the order intake in heavy engineering obviously is more profitable. We are working on increasing prices in the glass line business. Our, the proprietary product is obviously doing quite well. So we do have a plan that over the next maybe few quarters, we will start seeing an improvement in margins. Maybe Aseem, you want to jump in and just kind of talk a little bit more about what really impacted the Q3 margins here in India, and how do you see them going forward?
Yeah, thanks, Tarak. So yes, so I think Tarak covered most of the points. I think I'll just elaborate on heavy engineering a little bit. As you know, this is a line of business that we really accelerated this year, given the backlog we had. In the last 3 to 6 months, as we have shared earlier, we've been a lot more selective about the kind of orders we take in this business, and I'm happy to see the change in the margin and the backlog profile that we're starting to shift. So we expect the benefits of that to come really in the following financial year. And at the same time, our filtration, drying, and systems business, those continue to ramp up as well as the mixing business continue to ramp up very nicely. And we start to see profitability there. I think Manish will just add a couple more points.
So, just to give you a perspective, heavy engineering was more than 25% of the business this time in this quarter. So therefore, you see this sudden spurt in the Q3 standalone numbers to 276 crores vis-a-vis 256 crores in Q2. And on top of it, the major order that we had, the 100 crore order that we had, 30 crores was shipped out this quarter in Q3. And we expect the balance left over of something like 20 crores to be shipped out in current quarter Q4. And then we are done with that big order where it was really margin diluted. We did got something like 1% of material reduction, in fact, as positive impact in our P&L. However, this was more than done by this higher share of the heavy engineering business. If we actually take out internally, when we did the calculation, if we take out the heavy engineering business, the rest of the standalone business stands at 20+% EBITDA margin. And therefore,
and maybe let me just add in terms of business strategy, we've also kind of taken a relook at heavy engineering. We are kind of thinking of reducing our exposure there, keeping the revenues to a smaller number while filling that factory up with other products like mixing, like proprietary, and hopefully that will help us also kind of improve the margins coming out of the new facility in Patwa.
Is there a difference in the working capital between? Yeah, sorry, last question. It was just a follow-up to this one. Is there a difference in working capital between the HE business and the glass lining business?
Yes, it does consume significantly higher amount of working capital, both on the inventory and on the receivable side, simply because on the inventory side, the manufacturing cycle is that much larger.
Longer,
yeah. So longer. So, GLE would have a normally 3 months manufacturing cycle. HE may go from 6 months, 3 months as well. So
got it. I've taken up too much of your time. Thank you so much.
Thank you.
Thank you. Ladies and gentlemen, you may press star and 1 to ask a question. Next question is from the line of Sandeep Tulsian from JM Financial. Please go ahead.
Yeah, very good evening. Just following up on the margin question on international side. I think when we had guided originally to improve our margins to somewhere about 16%, the expectation was that although we'll maintain standard margins around 20%, there would be a significant step up in the international margins, which has kind of played out in the first 9-month period. So just want to understand where all do you further see scope of improvement in international margins from this 12.7% what you've reported in the current quarter, or do you think largely all of those improvement plan has materialized and this is where steady state margins should sustain?
So, hi Sandeep. Yeah, I think the international business today is in par with our India business. In the past, India business was accounting for nearly 70% of our total profit, while today the international business is nearly as big and as strong as the India business. So that's definitely a very kind of a heartening situation for us. We also see that this margin in the international business will continue. Some of the new acquisitions that we've done will only help us kind of improve and maybe grow this margin as well. One of the recent acquisitions that we've done with Mixel, again, mixing is a business that we really are focusing on. We're trying to create mixing as one of, a new kind of business line for us, again, because one, it's very much, it really has good margin. It's a technology play, so it really helps our customers improve, let's say, batch time, heat transfer, reduce power consumption. So it's really becoming more and more popular. Again, you don't have too much competition again, and it's a very, it cross-sells with glass-line very well, right? So across the board, it ticks all the boxes. It opens up a wide new set of industries, metals and minerals, water, waste treatment, cosmetics, food and beverages, besides chemical and pharma, right? So mixing for us is something that we really want to focus on. We really want to create a brand, a global brand, where we can really be one of the top 3 players in mixing globally, and that's what we are working towards. We are looking at some small acquisitions that will help us reach this kind of size and scale, and hopefully that's something that we can announce shortly. But generally, in the international, the acquisitions that we've made will only help us improve the margins. Hydro Air Research, again, has done quite well. They've seen significant order intake, again, a very kind of good technology product, again, with high margins. The services businesses are growing, again, high margin. Interseal is doing quite well, again, very high margin. So overall, we are quite confident that the international business margin should sustain. You will also note that now internationally in Europe, especially in Germany, we are now seeing prices of the gas and electricity coming down. So that's only going to have the positive impact. We've already taken cost reduction measures. For example, we've gone down to a 4-day work week in Germany, which has helped us. So we're working on a lot of different things. But generally, to answer your question, yes, I do believe the international business will continue to perform and maybe even do a little bit better. We have our CEO of the international business here with us today, so maybe he wants to jump in and just say a few words, Thomas.
Yes, thank you very much, Tarak. The international business is going quite well. We see still strong order intakes. The inquiries are still at a very high level, and we don't see any projects being postponed or canceled or anything by our customers and market base. And as Tarak said, we have taken a lot of actions countering the cost increases in material energy prices. However, the overall energy consumption and the cost of energy is less than 5% of the total revenue, so the impact is overseeable. And the energy prices coming down now will positively impact us because the current margin already includes higher energy costs that we have been absorbing. And so far, we are looking into, let's say, good foreseeable future on that point. So overall, business international is intact. Also in the Americas, good business activities, a lot of activities going on in inquiries, and order intake, especially in the service side, is pretty good.
Understood. Well, that's quite elaborative. Thank you so much for that answer. Second question that I have was on these acquisitions that we had done in India, that is specifically the D-Dietrich facility, the Hindustan Door or Liver facility. If you could give us some color how those acquisitions have panned out in terms of ramp up in production, what are the capacity utilization rates at these manufacturing plants, where are they in terms of what you envisioned 3 years back, to the scale and size that you can grow these businesses which you acquired. A bit more color with some quantification should help over there.
Sure. So this is a team. I'll take this one. There are 2 acquisitions that we've done in recent times in India: the Dietrich plant in Hyderabad and the HDO Hindustan Door Oliver plant in Vatwa, Ahmedabad. We're actually very pleased with the way both these facilities are ramping up. First, the plant in Hyderabad. This is a glass lining plant. The idea was to be able to be local to the Andhra Pradesh Telangana belt, where we have a key set of customers. I'm happy to report that over the last 2 years we have ramped up production to a point where we're doing roughly 2.5 times what that plant had achieved in the past in terms of revenue output. So we're very pleased with the way that's developed, and we continue to ensure that our processes are standardized, streamlined, and work just like a GMM Pfaudler plant. At the same time, in our Vatwa facility, which is the heavy engineering factory, again that's ramped up very nicely. And while we have had the margin dilutive issue related to the order, the production itself has come up very nicely. And so from an operations standpoint, we see we're quite pleased with the way this factory has ramped up as well. Anything to add?
Yeah, maybe that we've added a furnace in Hyderabad, the new furnace in Hyderabad, where we've expanded capacity there. We've added some factory space as well. We also are manufacturing some agitators, metal agitators for Mixion in Hyderabad. We've also manufactured new products in Vatwa. So we're really using all the real estate as much as possible. We also at the same time just commissioned our big furnace here in Karamsad, 80,000 liters. We have received 6 orders for 80,000 liters tank. These are the biggest vessels that can be made in India, and the timing was perfect. Just when we started this new furnace, we actually got these orders for CPVC projects. So timing was good, and we do have the capabilities now to make super large vessels here in India.
Thank you. Sandeep, may I request to come back in the question queue for a follow-up question?
Sure, I'm done. Thank you.
Thank you. Participants, you may press star and 1 to ask the question. Next question is from the line of Salil Desai from Marcellus Investments. Please go ahead.
Hi, team. I have a question, Manish, if you can help me understand this. If I look at the EBITDA in the international business, right, this is the number on slide 21 of your presentation. There's about 71 odd crores, right, which is the international businesses
right.
EBITDA, right? And if you look at the EBIT in the overseas business, I'm assuming these are like-to-like comparisons, right? The EBIT is close to some 14 odd crores, 14.15. Part of the difference obviously is depreciation, which I did some.
Sorry, Salil, we can't hear you very clearly. Can you maybe just slow it down a little bit and just speak up a little bit so we can hear you a little bit more clearly?
Sure, I'll do that. Right. So I think the EBIT in the international business is 71 crores. Sorry, the EBITDA is 71 crores. And the EBIT in the overseas business, right, which is part of the segment results, is some 14.15 crores. Okay, so I'm just trying to see how do we get from 71 to 14, right? I saw some depreciation could be about 20 odd crores, but if you could help understand, the rest of the bridge, it would be really helpful. This seems like a pretty large difference.
Right. So, Salil, you're right. So if we start with the segmental EBIT of 14 crores in Q3, so from that, we add another inventory provision of 14 crores. We add legal cost, exceptional legal cost of 8 crores, so that's 22 crores. Plus, we add this FX on the intercompany loan of 18 crores. So 14 plus 22 plus 18 makes it 54 crores, right?
Okay.
So that's the basic construct of this Q3. And likewise, if we see like to like, Q2 of EBIT said 69 crores, right?
Mm-hmm.
Now 69 crores had a 22 crore FX gain, right?
Okay.
So that 69 minus 22 actually makes it 47 on a like-to-like business performance perspective. So Q2 EBIT adjusted would be 47 crores. Q3 adjusted EBIT will be 54 crores.
Okay. All right.
Yeah.
All right. That helps. That helps. Okay. Right. And the next question, Tarak, this is for you now. When you say that you have some more acquisitions, in some planned or thought of, you're looking to add products, geographies. If you can just explain how much more do you need to acquire before, say, a portfolio you think is complete or?
So this is a part of our strategy. So when I spoke about mixing becoming a business, a standalone business that we really want to focus on, with the Mixel acquisition, we have now presence in Europe. Mixel has a factory in China, so we have a presence automatically in China. And through our Mixion business line here in India, we have a business here in India. So India, China, Europe taken care of. That leaves only the Americas as the place where we don't have a presence. So that's something, but it's in the same space as mixing. So we want to kind of combine these 4 geographies and have a global mixing platform that we can go out and we can sell. We can brand under one umbrella. We have one focused person. We've actually just hired a person who's going to take over as the head of the mixing business for the company eventually. So we're giving mixing a focus and the ability to grow. Like I mentioned to you, the market size of mixing is much, much bigger than glass-lined. It's a technology play, so high margin business. It's something that involves a lot of simulation, software, technology, proven track record. So companies who have supplied equipment in the past, that automatically qualifies you with large oil and gas projects, licensor projects. So it really opens up a really wide range of application and the industries that we can cater to. It's very much complementary to glass-lined. It's also very important today that companies are looking at ways to reduce batch time, power consumption, improve heat transfer, improve product quality and yield. So mixing is becoming a very, very important part of their the efficiency improvement programs, right? Most of these Indian companies have 300, 400 reactors, but if you can reduce the power consumption of each reactor from, let's say, 25 horsepower to 15 horsepower, you have tremendous saving be possible, right? So mixing is something we're focusing on. Mixel acquisition was the first step. We have something planned as well, something smaller, something not too large. Again, our size of acquisitions are not that big, between the $5 to $10 million range, but some of these acquisitions can double or triple in size very quickly. And our eventual goal in mixing is to be at least in the top 3 in the world, and that would put us in the $100 to $150 million mark, right? And that will happen eventually 3 to 5 years from now, and that's what we're aiming for.
Understood. Great. Thank you so much.
Thank you. Next question is from the line of Jonas Bhutta from Aditya Birla Mutual Fund. Please go ahead.
Hi, team. Just a question on just trying to put in place the commentary to the numbers. So basically, what we've seen is in the last 2 quarters, our order intake has sequentially declined from a peak of almost 990 odd crores down to 770 crores. But on the other hand, we also heard your comment where you said inquiries seem to be still robust. So how should we think about this in terms of, is this largely a timing issue where clients seem to be taking longer, or you're seeing genuine slowdown while people seem to be talking to you, but there is a general slowdown happening, particularly in Europe?
So I think it's a combination of multiple things. Generally, business environment is a bit subdued over the last maybe 2 quarters. I think the Ukraine war, the global inflationary issues and problems going on. But the inquiries still continue. Maybe the time they take to finalize has kind of increased. But we are seeing again some kind of a reversal in those trends. We have over the last quarter seen significant projects here in the glass-lined part of our business here in India. Like I mentioned to you, yes, we've seen some slowdown in the systems business internationally, but the opportunity pipeline remains strong. We do expect some large orders to come in the 4th quarter. Luckily for us, we have a large backlog in most geographies, 6 to 9 months, in some cases even more than that. So that gives us good revenue visibility. We also have the ability now to kind of target some orders which usually or earlier we could not target. Now with India being part of the global sourcing program, we have the ability to enter new markets like Eastern Europe, Southeast Asia, some parts of Spain and Africa. So, there's a lot of opportunities available, but generally we have also been kind of selective in terms of what we take. And I think one of the things in India especially that we've done is we've kind of been selective both in HE and in glass-lined. But glass-lined has picked up last month, and we expect that to pick up as well. I think the other thing to keep in mind as well is that last couple of quarters we had a large orders from heavy engineering, but because of the large backlog that we have in that business, new orders will take some time because we already have our factories full for 9 months. So we expect orders in HE to come in the next few quarters. And the Mawar, for example, our Swiss subsidiary has a backlog of close to nearly 15 to 18 months, right? So generally the activity is there. They're still finalizing new orders. So there is activity going on in Europe and in the US. India is also picking up. Maybe Thomas, you want to add something on what you're seeing in Europe and in India?
Yeah, so I'm looking Thomas, I'm looking at the European and the American activities, as I said before. I think they are quite normal on a high level still. Demand is not really slowing down. I think we have seen the last couple of years a slightly overheated situation that is coming now back to a normal situation. So the decision-making process of customers are not slowing down more than they have been before. They were extremely fast over the last 2 years, and that couldn't hold forever. So we are not concerned about order intake, about the demand that is seen in Europe or in the Americas at this point.
I think for India, we are seeing, as Tarak mentioned, a lot of activity, especially in the specialty chemical space. Order book there is actually growing quite nicely on the glass line equipment particularly. While pharma continues to remain somewhat subdued, overall, we are pretty satisfied with the way our glass line backlog is going. So.
Got it. And, just from given that we don't have too much of a history of, how, order books used to behave for PFI before it came in, given that we are sitting on a backlog of about 20 to 50 odd crores, and even if we sort of conservatively grow our sales next year by about 10%, we're talking of roughly 3,300 kind of number. With this kind of backlog, what kind of order intake that you think that you'll have to pull through so that you can comfortably sort of reach, at least a 10%. So, it has typically order book to sales coverage been 0.7x, or, this seems to be on the lower side, just from a historical perspective.
No, I think from a historical perspective, I think this is record order books. They used to be much, much lower. In India, obviously, we do try and start the year with at least half the order book of what the year's target is. So let's say, for example, if we have a 1,000 crore revenue target, we should have at least 500 crores of revenue on hand. So from that standpoint, half the revenue, half the order backlog is already on our books. We will book new orders in Q4. Also, what you probably don't consider in this is spares and services, right? These are ongoing and these are short delivery items and get booked continuously. So that will only add to it. So I think we're quite comfortable from order backlog standpoint, and that's why I mentioned we have about 6 to 9 months of visibility. We don't have any kind of urgency in terms of bringing in orders or dropping prices, pricing. We know there are large orders in the pipeline. We know large projects here in India that are currently happening. We have good projects on hand in Europe as well. So overall, I think we are in a strong position. But like there is cyclicality in the market. There will be ups and downs. But the current backlog gives us a strong kind of a base to build on.
Got it. And the last one that I had was on margin. So, you mentioned that the heavy engineering piece still has a legacy order book of 20 to 30 crores, which probably will get executed in the fourth quarter. So is it fair to assume that the fourth quarter margins of the standalone piece would sort of be similar to the Q3, or there are levers there also which, you think will help us better margins there?
So, obviously we are looking at internal measures to reduce costs, but I would stick with the current margins that we have been delivering. Obviously there will be new orders coming in, but again, metal prices again have kind of stabilized now. There's been some talk that it might even go up. So we have to be a little bit careful, but I think we definitely have opportunities to reduce costs internally. Our team, Manish, are working on that. There's currently a procurement activity going on with the help of a consultant to look at large, contracts and to find ways of buying them more efficiently. So all those things will be ongoing, but right now I don't want to really change that number for the last quarter. We do always try, and next year hopefully we have some actions in place where we can see some improvement in margins here in the India standalone number.
Sure. Thanks a lot and all the best.
Thank you very much. Next question is from the line of Bhavesh from GD Investments. Please go ahead.
Hi, sir. Can you hear me?
Yes, loud and clear.
I just wanted to understand on the valuations front. So can you just give me a brief on the valuations, what we acquired the pending or the remaining 46% which we acquired on that front?
Manish, valuation of the 46%.
So I think we have a detailed presentation sent out for this at the time of acquisition, and it compares all about the, I think, if you talk about the EV EBITDA multiple, it's for 6.5. That was the valuation multiple, if that's what you're looking at.
Okay. And just on the 2014 DBAG one?
Oh, DBAG had acquired in 2014, they acquired the Pfaudler Group. I'm not sure at that point because it was done directly with another company. What DBAG ended up paying, I have no idea. That's something that is not in the public domain, and that was done between NOV, who is an American company, and DBAG. Not sure of those numbers, but the 2020 numbers as well as the 2022 numbers both have been compared, and they are on our website. You can have a look, and all the details in terms of EV valuation multiples are all part of that presentation.
Okay. And just one another question that in the chemical side, are we catering to only is there any segment which we are not catering to other than agro and specialty chemical? Is there some another sector or profile?
So obviously agrochemical and specialty chemicals are the big ones. We also do dyes and paints for glassline equipment. In pharma, we do API, basically bulk drugs and API. We don't do formulations really. There are certain applications like fluorination. Anytime you use fluorine, you can't use glassline because it reacts to glass. But besides that, all major applications in chemical and pharma, and when I say chemical, agrochemical and specialty chemical will require some kind of glassline equipment in their plant.
Okay. Thank you. Thanks for that.
Thank you.
Thank you. Next question is from the line of Venkatesh Balasubramaniam from Axis Capital. Please go ahead.
I actually had one question for Manish and one question for Tarak. Now, firstly, Manish, last year, if you actually see the fourth quarter results, fourth quarter last year, effective tax rate was almost 60% odd in the fourth quarter. Are we expecting similar level of effective tax rate in the fourth quarter? This is a question for Manish.
So, hi Venkatesh.
Yeah.
So, effective tax rate for the organization stands at 27%. However, there have been fluctuations, on the positive and the negative side through the quarters. As we've seen, there have been deferred tax reversals and for the credits in last quarter as we saw. And similarly, this quarter as well.
Sorry to interrupt you.
Hello, can you hear me, Venkatesh?
Yeah, I can.
Venkatesh, may I request you to mute your line from your side when you're not talking because there's a lot of echo from your line. So you may go ahead now.
Sure. Similarly, if you see for the current quarter Q3, you have a PAT of 19 crores, reported number, and if you add 27% of normal tax rates, you give up 5 crores of taxes. And then the forex MTM that we spoke about, that's 18 crores, so that will give you, that will obviously is non-tax deductible, so that's a 6 crore impact, and rest are the minor deferred tax accruals and deferrals, and because of that, we come to the number that we have at 34 crores.
Okay. The other question is to Tarak. Now, obviously, you are planning to buy 1% from DBAG fund, and I believe that you need some regulatory approval. So what exactly is this regulatory approval which you are waiting for, and when does this come to? That is first part of the question, and when will this happen, this 1% stake purchase? Secondly, I guess when you actually buy from DBAG, it's an inter se purchase, so it doesn't trigger an open offer. So does it also mean that when the next round of, the remaining 13% of DBAG, whenever that comes to the market, you will be looking to buy more? Because if you don't buy from them and you buy from the open market, it might end up causing an open offer. So are you thinking about increasing the stake even further in the next round? So if you could provide some color on that, that would be useful.
Sure. So Venkatesh, let me start off first with the approvals required. There are 3 approvals required: UK FDI, French FDI, and Italian FDI. Both of these 3 approvals are only getting triggered because we are crossing the 25% mark when we acquire this 1% stake from DBAG. Those applications have already been made, and we expect that and the CCI approval to come sometime in the mid of March. So we expect the transaction to be completed in the March month, end of March, something like that. When we acquire this 1%, we will cross from 24.2% to 25.2%. So we would have crossed that threshold. After crossing the 25% mark threshold, we can then free from the market, we can buy from the market. So any more acquisitions of shares will not trigger any open offer because we've crossed that 25%. Do I plan to buy more from DBAG? Obviously, when that time comes and DBAG is looking to sell that stake, we will think about it. But right now, my first goal was to cross the 25% mark. I've also mentioned in the past that yes, as the dominant promoter, we would like to be somewhere around the 28 to 30% mark. If that is possible, I would like to do that. Timing, I'm not really sure. But if there's an option to buy something from DBAG, sure, we'll consider it.
Okay. Thanks for those answers. All the very best.
Thank you.
Thank you. Next question is from the line of Ronak Vora from AUM Fund Advisors. Please go ahead.
Hi, sir. When we say our hands are full with the order book of 6 to 9 months, what kind of capacities do we have in hand currently, as in what kind of utilizations are we at and where can we reach?
So I would definitely say that in our India glass-lined business, we are not at full capacity. India has a backlog of about 6 months. So there's definitely potential to kind of improve the capacity in India and take more orders. Like I mentioned to you, orders have been, we've been choosing and picking orders carefully to make sure that we do a good margin business. But in Europe and the other geographies, we do have higher capacity utilization, and I think the order backlog there is much stronger. They have about 9 months in most of the glass-lined factories, so there the utilization rates are much higher. I also mentioned that we have kind of reduced, we've taken some steps to reduce stocks in Germany, where we've gone to a 4-day work week, but they are still producing the same amount, the amount of equipment. So there the utilization has actually improved. We are also working on a global operational excellence program. So we have seen significant improvement in our China facility. China is really an area where we want to grow market share. We have a brand new facility there. We have new furnaces there. They just recently also finished manufacturing a 140,000 liter glass-lined vessel, which is the first time it's been done in the group. So we have really big plans for the China facility, and hopefully market share in China can increase significantly.
Just to add, as a recall from our investor guidance that we gave, we do not expect to make any significant capex for our guidance of 3,700 crores. We actually think that we should be able to do something like 4,000 to 4,500 crores out of the current capex. So if that answers the question.
So basically, currently your gross block, which is at 1,300 crores, can do 4 to 4,500 crores of top line, correct?
Yeah.
Okay.
Of course, there will be maintenance capex throughout, as we mentioned in the guidance period, in our guidance presentation as well. So there you should expect a 2.5-3% of capex in our regular.
Yeah, that's. I'm just getting rough figures. I don't want anything. Ballpark is fine with me. Secondly, you said that India is underutilized and we are picking orders. Is it something because, the pharma industry, India has been dull, the chemical has been pretty good. So is it something that, there are lack of orders in the market, which is leading to just 6 months of order backlog?
No, it's a combination of multiple things. I think one is that most of our furnaces in Gujarat are on gas, so we try not to use the gas furnaces and use it at spot rate basis. So we try and consume the gas which is at the lower prices. So we don't need to kind of extend and use these furnaces 24/7. So we've been a little bit conscious about that. Plus, we now have the Hyderabad facility, which also has capacity. Like you rightly said, there has been a little bit of a slowdown when it comes to pharmaceuticals, but then the agrochemical and specialty chemical sectors are making up for that shortfall, right? So there are large projects in the pipeline. PI Industries, NPP 12 and 13 is coming. SRF just announced a new agrochemical plant. Magnani is putting a CPVC project. These are all large reactors. Deccan Fine Chemicals is expanding as well. So there's no shortage of orders. Expansions are happening. India will continue to invest in chemical and pharma. Obviously, in the past, earlier on, maybe if you look back 10 years, pharma used to account for nearly 60% of our glass-lined business. Today, only accounts for 30%. So pharma has definitely slowed down. This has been replaced by chemicals. Hopefully, pharma will start coming back, and that will also add more orders coming into the market, and it will definitely mean more business for us as well.
Okay. Thank you.
Thank you. Next question is from the line of Rohit Ohri from Progressive Shares. Please go ahead.
Hi, Tarak and team. Two questions. The first one is related to this holding of Pfaudler INC. So is there any binding clause or binding agreement or contract? Because we had some of these contracts in the past for 3 years. So are there any more contracts or are they willing to extend it going forward?
No, so there's no real contract in place. But again, I mentioned that DBAG is a responsible shareholder. We will only sell, and they will only sell when the time is right and to the right set of investors. So again, there is no specific time frame. As and when the demand is there, the right price and the right set of investors, we would like to do the transaction. And obviously, being private equity investors, they have a financial time frame. They've been around since 2014. It's already now nearly 9 years. So the time frame is probably at the end of their time frame. So when we find the right solution for them, I'm sure they will be looking to exit and at the right time.
And if you can just share that, what is the timeline? Is it like September, October, or?
So I can't really say any timelines right now. There is no specific timelines. Again, it all depends on what happens in terms of the demand, the interest levels. So as I said, at the right time to the right set of investors, we will then plan that sale accordingly.
Okay. My second question is related to the split if you do in the segments and sub-segments. We see that the standalone and international has been reducing in terms of the percentages for technologies. And on the same hand, the systems and the services is growing and it is inching slightly more towards the north side. So any guidance you would like to give on this, or will this trend continue with technologies becoming slightly bleaker and system services going towards the north?
Just maybe Tarak and Aseem and Thomas can explain. Just to give a perspective, technologies is growing naturally slower than systems and services because systems and services are the new businesses that we are. So it's all relative because ultimately the pie has to stack up to 100.
I think you said it very well, Manish. Thank you. This is our core business where we have high market shares in all the regions. And therefore, we grow consciously with the market. We're not growing market share at any price. We're making selective decisions on what orders we take and what orders we're not going to take. And the other segments are our pure growth segments where we are investing in capacity and also in M&A. And those are the segments where we are looking for growing the pie and getting a bigger piece of the pie. And they are naturally, as Manish said very well, the growth rates to the expected are significantly higher.
Okay. So these service contracts.
I'll request you to come back for a follow-up question.
Okay.
Thank you. Next question is from Jayveer Shekhawat from Ambit Capital. Please go ahead.
Hi, team. Thanks for taking my question. One question, if I remember right, I mean, in the previous call you had mentioned that the reason why you're not participating, especially in the kind of orders that your domestic competitor usually gets into, is because these are on the lower end of the F&D. Now, when I look at their margins, whether be it the gross margin or the EBITDA margin, they seem much better despite having the higher mix of that lower end of F&D. So could you just help me understand and probably provide your perspective as to how probably they are able to make better margins despite being on the lower end?
I'm not sure what you're speaking about, but in terms of glass-lined, obviously we are the market leader. In F&B, filtration and drying, we are definitely not the market leader, and we focus on the high end, any kind of, filtration and drying which requires technology. That's what we really focus on. I don't have access to, I have access to my competitive numbers, but I don't really know how and why those numbers are, the way they are. What we can tell you is that being a market leader, we drive price. Price is important for us, and we make sure that we will only do business in the glass-lined segment at the price that makes sense to us, as the leader, and we do command a premium when it comes to glass-lined because of our quality and our technology. Even in the F&B business that we do, we have specific products like the spherical dials, like glass-lined ANFDs, like BTDs, again, very specific, very kind of critical, and hence again the margin profile there is significantly better, and that's what we really focus on.
Got it. Sure. That's helpful. Thanks a lot.
Thank you very much. I now hand the conference over to Mr. Tarak Patel from GMM Pfaudler for closing comments.
Thank you very much, everybody, for joining the call. Have a nice weekend, and we will talk to you, after our Q4 results. Thank you very much.
Thank you very much. On behalf of GMM Pfaudler Limited, that concludes this conference. Thank you for joining us. You may now disconnect your lines. Thank you.